Are we live? Yes. Good morning, everyone. Good morning, sir.
Thank you.
When we hear of ADGM, two things come in our mind. The first and most important one is this unique style building that they have in the beautiful island of Al Mariam here in Abu Dhabi. And the second thing, it's charismatic leader who turned around the ADGM FSRA and left a legacy. Mr. Richard Teng, our keynote speaker for the 54th edition on NFJS. Welcome, sir. At ADGM, his major focus was to develop new innovative regulatory regimes and offerings that bridge the gaps in the ecosystem, reimagining what the future state of financial services would be and attracting new market participants while creating new market opportunities not offered in any other regional jurisdictions. Mr. Teng served as the Director, Corporate Finance with MAS, which is the Monetary Authority of Singapore, and Chief Regulatory Officer of Singapore Exchange and Director before joining ADGM in 2015. With over 20 years of regulatory leadership and financial sector development experience, Mr. Teng is known for thought leadership on financial regulations, fintech regulations, Belt and Road developments, and governance. Mr. Teng, welcome to Lulu Financial Group and to the venue. Thank you very much for your presence, sir.
Thank you so much. Thank you for the introduction, very kind introduction. And thanks for having me for this 54th edition of No Fluff, Just Stuff. So a special thank you for this invitation. I think it's very inspirational to see what you have done with Lulu Financial Group and Lulu International Exchange. I wish you every success going forward. Carry on all the fantastic work that you have been carrying out. So maybe if I can just elaborate slightly more on what was said. Until about a week ago, I was the CEO of Financial Services Regulatory Authority at Abu Dhabi Global Market. It went live. ADGM, as you know, is a very new international financial center. It went live 5 years ago, starting from ground zero. We started from nothing, building something out. And if you look at what ADGM is today, it is quite different. We are a multiple winning international financial center. We are the fastest growing international financial center. And last year, despite COVID situation, we have experienced exponential growth. Just in terms of asset under management in ADGM, it went from $29 billion in 2019 and closed the year at $83 billion in 2020. So you see more than 4 times growth in terms of asset under management alone. And that trajectory is still going very strong. So I'm very happy to leave behind very, very strong and good work to my fellow colleagues to bring it forward. Prior to that, I spent time at Singapore Exchange, 7 years, where I look after capital markets development, listing needs of companies, member firm supervision. And prior to that, with the Central Bank of Singapore, the Monetary Authority of Singapore, we have the good fortune of regulating across banking, insurance companies, capital markets intermediaries, exchanges. But I was also doing financial center development, being part of that movement to develop Singapore from a regional center into a global international financial center way back in the 90s, right? So I was part of that movement. I was sent to New York for 2 years to attract international stakeholders to anchor themselves in Singapore. So it was an exciting time for me. And that's how I got this job when ADGM wanted to start something, a new international center, given my experience in financial services development, center development, as well as regulations. So today I'm going to my presentation is going to focus quite a fair bit on financial center and why financial services are extremely important, why government are spending resources to build it. I'll use ADGM as a case study, given my most recent experience. I also highlight some of the mega trends that you see will impact our lives, will impact the financial services sector, and some of the things to look out for post-COVID that will be useful for you as you continue to strategize your business going forward. So why do countries spend so much resources to try to build up their financial services sector, right? I think it's quite important to remember financial services do not exist for its own benefit. It exists as a lubricant for the other parts of a very important economy. It exists to support production, it supports manufacturing, supporting the services sector, right? It provides an efficient mechanism in terms of bringing the deposit savers money and directing them towards the highest area of growth, highest areas of venture, and highest areas of return, especially for entrepreneurs and for the economy. And that results in wealth creation, it results in multiplier effect for the economy, and it results in income growth that in return benefit the financial services sector in terms of deposits, insurance, demand for investments, trading, and so on. So it's very important to have an efficient financial services sector, right? Without that, funding costs will increase. And once funding costs increase, you see a lot of deserving ventures not being able to take off the ground. You see entrepreneurs being deterred from getting into new ventures. And as a result, the entire economy become worse off, right? So that's one of the key reasons why financial services and financial sector exists, is to really support the other important verticals within the economy. If we take a snapshot of the top 10 financial centers and study the evolving landscape of financial centers. So if you look at way back in the 80s and take a look at the top 10 global centers at that point in time, the number one center is New York, followed by Tokyo, then London. Number 4 is Frankfurt. You have Hong Kong at number 5, Singapore at number 6, 7th, Paris, Los Angeles, Milan, and to round that off, you have Toronto. So you can see a pretty good dispersion, geographical spread of financial centers in the top 10, right? 3 North American centers, 3 Asian centers, and 4 European centers. And the hypothesis at that point in time, projecting forward, is that given the Eurozone, the coming together of European Union, the growth of Eurozone and the growth of a lot of multinational companies in the Eurozone expanding their footprint globally, the Eurozone financial centers will grow in strength, right? So the likes of Frankfurt, the likes of Paris is expected to become much more important. And many people predicted that that would impact London as a financial center, right? Because with the rise of these other European centers, London will become slightly less important over time. But if you jump to today, 2021, and you look at the landscape today, it presents a very, very different story, right? Given the hypothesis and projection then. The top 10 ranking today, you still have number 1, New York. Number 2, London, displacing Tokyo. Number 3 is a new entrant, Shanghai. Number 4, Hong Kong. 5, Singapore. 6, another new entrant, Beijing. Number 7, Tokyo. So Tokyo has dropped quite drastically from the number 2 center in 80s to number 7 today. Number 8, again, is a new entrant, Shenzhen. Number 9, Frankfurt. So Frankfurt dropped from number 4 to number 9. And 10, Zurich. Right? So why is this happening? You have one outsized, very important center in North America, in New York, where you see a lot of consolidation of activities, aggregation of financial services for North American region and for global, especially in capital markets front, right? But you have now 6 Asian centers in the top 10 and 3 European centers. So other than London, the rest are much lower down in the ranking. You see this because if you look at economic growth, if you look at demographic shift, if you look at government policies in the last 30 years, those give rise to emergence of Asian centers, right? So if you just look at past 10 years alone, China itself accounts for 1/3 of global economic growth, right? Other emerging markets, which a large part also include Asia Pacific markets, and India and Latin America, etc., they account for another 1/3 of economic growth. So together, all of them accounted for 2/3 of global economic growth. If you take those equations out, the developed market in the States actually is growing at a very slow pace compared to emerging markets. And as I mentioned, financial center exists to support production, manufacturing, services sector, etc. So it is no wonder that given the type of financial intimidation that's happening in Asia Pacific, that you see the big rise in Asian centers, right? And that trend, the momentum is pretty strong. We're just discussing about Singapore and what's happening in Singapore prior to this. We see very strong trends. We see very strong fund flows into Asia Pacific as of now. Moving forward, I asked a question, what would you see in the year 2050? How would the landscape be, right? So it's anybody's guess, but very much would depend on a few factors. Demographics growth, economic growth, governmental policy, enabling regulations to support new areas of growth will be extremely important. I do foresee the rise of Indian centers in this equation, right? I can't predict whether they'll be in the top 10, but given the demographics and the strong growth that India is going to experience in the next few decades, you will see the rise of Indian centers, right? You will see the rise of Middle East African centers as well. May not be in the top 10 by 2015, but they will definitely rise in prominence among global centers. Why is that the case? If you look at our demographics in this region, and we always group Middle East, Africa, South Asia together as a big hinterland for growth, for market penetration to roll out product classes, right? But if you just even take out South Asia and just focus on Middle East, Africa region, this region alone will account for 50% of the world's population growth by the year 2050, right? So that's a huge driver of growth for consumption, for production, for manufacturing, for demands of financial services. That's why if you project yourself 30 years forward, the dynamics will be quite different. But there are challenges. But these challenges also present opportunities that you can tap going forward. So what are some of these key challenges? 85% of adult population in this region is unbanked, right? So that demonstrates a huge challenge in terms of pushing out financial services product, but a huge opportunity as well, because given the untapped potential there, right? It is something to be excited about. If you look at SME funding, SME lending space, the credit gap for micro, small, medium enterprises stands at about $260 billion US dollars. And that's the estimate of IFC, right? If we can find ways to really inject liquidity, inject alternative source of funding into that space, putting money in the hands of entrepreneurs, small, medium enterprises to work and generate returns and growth, it becomes another huge important pillar of growth for this entire region. So that's why quite a fair bit of focus, we are now all talking about fintech and different ways of delivering products and services to clients at a much lower price point. And that will become very, very important for this region, especially as you look to tap all these opportunities going forward. And that formed the hypothesis way back in 2015 when we started ADGM. ADGM went live in October 2015. As part of financial center development or as part of any business strategy, I think it's quite important to look into the future to understand trends as well as mega trends coming our way so that you can ride those waves, you can harness on your competitive advantage and take advantage of them to grow your business. It's extremely important. And that's what we did in 2015. And we keep revisiting whether our strategy is correct. One of the strategy, as I mentioned, given what we saw going forward in terms of demographics growth, in terms of the needs of the region, one of the areas and pillars that we focus at ADGM to make ourselves quite different from the rest, especially in 2015, was to focus on fintech, right? So in 2015, when we speak about fintech, many people in the region have not really heard about it, right? So when we started pushing it, I don't only face an external question, what is fintech? But internal people, my colleagues will ask, why are you focusing on this area? Why are you not focusing on the more traditional areas? We do focus on traditional areas. We do focus on private banking, asset management, traditional banking as well. But in order to capture all these new opportunities of growth, you have to also place resources on that, which we did. We placed resources on things like sustainable finance, and you see the wave in the last few years of sustainable finance. So we started placing our bets, so to say, or where are the new mega trends coming forward, and how do we take advantage of those opportunities. And when we first started ADGM, I must add that there are many naysayers to say that ADGM wouldn't succeed, right? If you read the market commentary at that point in time and newspaper articles, there are many skeptics. And why are there so many skeptics? Because the main concern they have, or the main issue they saw, was that there are so many financial centers in this region. You have Dubai, you have Qatar, Bahrain, Riyadh, etc. And most of them have more than 10 years of track record. Some of them are doing pretty well in this region. So why do you need another center here to drive growth when Dubai is 1.5 hours down the road, right? But they are missing a huge part of the narrative. And what's the narrative? If you look at what's happening in this region, especially then, financial services are being exported. You have 3 of the largest commercial aviation companies in the world in this region. But aviation financing is not conducted from here. It's conducted elsewhere, other parts of the world. You have many good companies here, but when companies want to do an IPO, and if they want to be a unicorn, etc., where is the natural destination? A lot of them do not want to be listed here. They are listed overseas. Same. This is a great place for people seeking to raise new funding for their ventures. So you have overseas people coming here, talking to the likes of sovereign wealth funds, family office to raise funds. But asset management industry, private wealth industry is still nascent, right? So all those are happening. And that means the ecosystem is incomplete. The value chain system is incomplete. One of the biggest challenges is how then do we create and develop and plug the gaps within the ecosystem to make it a full financial center, to bring activities back home. And it's quite important to bring those activities back here to be conducted from here because they create and they provide huge multiplier effects for the rest of the economy. When you create financial services activities here, you create jobs, they create consumption, demand for real estate, demand for residential, etc. So there are huge multiplier effects to benefit us. And that's what we did. On the fintech front, we are the first to fly the flag in fintech in this region. And by the way, before I finish off that point, for everyone that say there are too many financial centers in this region, my point is there are not enough financial centers and not enough financial activities. Just look at Asia, right? Asia centers are competing with each other, but all of them are prospering today. You have 6 Asian centers in the top 10. So it is not about how many centers you have. It's about what activities you're conducting and how you go about bring those activities and conducting much more financial intermediation. So going to fintech front, so we place our strategy, a large part of it on fintech, of course on other things. I've not mentioned the other things because I think today's focus is really on fintech. And we started that journey by rolling out a regulatory sandbox, the first in the region in 2016. And from there, what it enables us to do is to work very closely with firms with new business ideas, new business model coming through, with the entrepreneurs, techpreneurs coming through, understand the type of risk they can bring to the system, and then modify either our rules and regulations, our regulatory framework, or formulate new areas of regulatory framework to support them in their growth, right? So by now, this is a very successful regulatory sandbox. It's the second most active globally after the London sandbox. And it has benefited us greatly because then we get to work with all this new business model, understand them and support them. From there, we started rolling out many new things, right? First one is in 2017, securities token offering, right? So securities, you digitize them, you then offer them into much smaller fractions, for instance, right? So the NFTs of today that you see is a part of tokenization, right? NFT stands on non-fungible tokens, for those that are not so aware of it. So we started that. We pushed and we saw the gap in terms of venture capital funding. There's still a lack of venture capital funding in this part of the world. So we calibrated and introduced a venture capital manager framework, which is provided us with huge upgrowth. So when you saw the amount of asset under management increasing sharply last year, a huge part of it is also due to new venture capital money coming in. So those invest in startups, seed stage companies, fast growth companies, small and medium enterprises, and they're very important for the ecosystem to support the funding gap that we saw in the marketplace, right? In 2018, we are the first regulator internationally to introduce a very comprehensive framework to regulate cryptos, right? So if you move yourself back again in 2018, the verdict is out there. People think it's all hype. People think it's something that will go away, the crypto world. But when we look at it, we think that there's a business case to it. And some of the other regulators either choose not to regulate that space or regulate it with a very light touch, just focusing on AML KYC, right? But if you read the media article then, you see coins being lost or stolen, right? You see plenty of coins lost or stolen, people misplacing their private keys and the money is lost. And we say that in order to regulate this space properly, you need to manage the risk in the different dimension, right? So other than AML KYC risk, you need to regulate risk on the custody side to make sure that the coins are properly stored and safeguarded. You need to look at technology governance risk. You need to look at exchange operational risk to make sure there's no wash trades, to make sure that trades are conducted properly, best execution for customers, right? So we came out with a very comprehensive framework, which has been subsequently copied by many other jurisdictions, by the way. And the reason for why we did that is if you don't do it, that space will still become a predominantly retail space, right? So only retail investors will invest in it. Institutional investors wouldn't touch it. And for any marketplace in financial services where you do not have institutional investors in it, it tends to be very volatile, that asset classes, right? You go through sharp increase, go through sharp decrease, because there's no stability from the institutional investor class. And for institutions to come in, they need to make sure that all these risks are being addressed and mitigated. So that's what we did. So the likes of Kraken, which is one of the top exchanges in the world, will commence their operations this year in ADGM, right? Of course, we have approved 7 other exchanges by now for operations. The first one will actually be operating by end of this month. Right? Then we push forth with areas of robot advisory, an area again you see huge uptick, right, in many parts of the world. Slashaway, which is a Singapore robot advisory firm, managed to gather 1 billion of assets within a short span of less than a year. So you can see the growth momentum of many of that area coming forward. Moving to areas of API framework to allow for open banking. Again, another important areas of growth. So other than supporting industry growth, we also undertake experimentation on our own, because it's very important to regulate all these enterprises for us to invest in areas of RegTech, right, in order to regulate them well. And also looking at ways to support growth in other dimensions. So on our own, we also undertake studies, experimentation in the area of tokenization. So if you look at how products are being offered today across jurisdictions, if you think about it, product from the States to be offered here, you have to go through filing, you have to go through approval, etc. And the rules and regulations for each jurisdiction is different. If you imagine, given the type of technology we have, if you tokenize a particular investment product and you code that token with the rules and regulations of different jurisdictions, US, Singapore, Hong Kong, UAE, etc. So that if you, let's say, want to offer it to a particular class of investors, let's say accredited or professional investors, definition of different jurisdictions are different. Right? But if you have that token, you can first make sure that in every offering in different jurisdictions, you comply with local rules and regulations. The regulators are assured. If it's a debt security product, you can add smart contracts to that, so that at every 6 months, every year, the coupons are paid automatically. When you transfer that token, the legal rights get transferred automatically and it's immutable. So you can do a lot of those key things, and the process is become much more efficient and safer, right? So we did that. So we are on our experimentation with the US SEC, Securities and Exchange Commission, with Australia, Securities Commission, to allow for all this compliance token to be offered cross jurisdiction, facilitating compliance, facilitating cross-border offerings, and facilitating new funds being rolled out that can gather money quite quickly. If you think about Wirecard fraud and the Wirecard scandal, it is quite puzzling in this day and age. You are still relying on auditors to do annual cash validation, right? Because technology have moved so fast. Why are you still relying on so archaic method of validation? If you start to think about it, there must be much better ways, right? We were just discussing, I was trained an accountant. So this is something that, when you start to take a step back and you start thinking about it, why are we still doing it in this day and age, right? That's where we also introduce RegTech solutions to allow regulators like ourselves and financial firms like yourself to be able to track cash balances, to do cash reconciliation on a real-time basis, to make sure that customers' money are protected if they are properly segregated accounts, right? So things like that, we did quite a fair bit of experimentation on that front. Of course, that is only part of the regulatory front. If you want to develop the ecosystem, you have to look at end-to-end. How do you support innovation? How do you support incubation? How do you support acceleration? How do you support the firms trying to roll their products and work alongside with financial firms as well as corporates to introduce and scale their production, right? Funding is required. Hub 71 was created with support from Mubadala, so the partners Mubadala, Microsoft, SoftBank, Abu Dhabi Investment Office, ourselves, bring this together. It creates an ecosystem for the startups to get together, right? It creates an ecosystem where people can meet, can explore, can think of new business ideas, can tell their stories of what else is needed from their end, and we can support them. And it's extremely successful. They keep running out of space, they keep taking out new floors because that area is expanding so quickly. We work with the likes of Plug and Play, which is the fastest, is the largest accelerator around the world, so their presence globally, with the exception of Middle East. So they did not have presence in Middle East until we brought them here. And they are one of the largest VC investors as well. So they invest a lot into the startup space, the seed space, fast growth company. So we look at the entire spectrum, and we are very fortunate that Abu Dhabi government has been extremely supportive. You see different funds being set up. Mubadala Venture Funds investing into this space, ADQ investing into this space via ADQ Wave, Catalyst Funds putting aside money to invest into this space, Abu Dhabi Investment Office, Garden Venture Funds really setting aside money because this is the wave of the future. This is your doorstep into a digital economy and digital future. So it makes sense to invest a lot into this space. The three fastest pillar of growth that we are seeing in ADGM itself, other than fintech, is the area of health tech and agri-tech, right? So we see very strong and robust growth in multiple pillars within ADGM. In the process, we created the largest fintech festival for this region. Our fourth Abu Dhabi Fintech Festival last year has about 7,700 participants, which is the largest fintech gathering for this region, right? So we're very happy to bring together thought leaders, entrepreneurs, investors, businesses, financial institutions to continue to press ahead with the agenda on the fintech front. I'm going to move from there and now go into some of the mega trends that you're going to see going forward, right? Take this with a pinch of salt. It's looking into the future, it's anybody's prediction, anybody's guess what's going to happen. But based on current trend, these are some of the things that you might see or you are already seeing, right? One of the big mega trends that you're going to see that is going to impact a huge part of our life, be it work, social, is really deep learning, right? So deep learning is a very important breakthrough for the future. Until recently, humans program software, right? Deep learning uses artificial intelligence that uses data to write software. And by automating the creation of software, deep learning can turbocharge almost every industry that you see, from clean energy cars to how you do gene therapy to development of drugs, etc., etc. So it's going to be quite huge. And with that, you will see much greater need for computational powers, right? For processors, for chips. And you already see a shortage of semiconductor chips, right? NEO has to close down its clean energy plant for 5 days because it ran out of chips. And the chip shortage is going to last, especially at the very high end. You're going to see reinvention of data centers. So the data centers today will have to be redeveloped, revolutionized, right? Cheaper, faster, more powerful chips and processors will have to come into place to replace them. So you're going to see that as one of the trends going forward. Another mega trend, virtual world. So the virtual world, computer simulated environment, is expected to grow at a compounded rate of 17% annually. And that's pretty big growth, right? So it's going to be the third place for most people away from home and office environment. If you look at video game monetization, it is quite interesting. So if you look at 10 years ago, most video games monetize it via their subscription base, right? So in-game purchases account for about 25% of their revenue base. If you look at today, in-game purchases is about 75% of revenue. So people are much more willing to spend in that space. They become much more acclimatized in that space. And looking 5 years forward, that figure is expected to grow to 95% for in-game purchases. So it provides a huge opportunity for growth. That's why you see a lot of video games makers, offerers, providers are doing extremely well globally. The likes of Tencent, the largest company in China, is a big game developer. The likes of Sea in Southeast Asia, for instance, that's listed in in New York Stock Exchange. Right? So you will see a lot of those trends. Another one of the virtual world is augmented reality, right? As that technology improve, given the amount of investment into that space by the likes of Snapchat, Apple, Google, Facebook, etc., into AR glasses, AR headsets, AR mobile, that space not only will grow in terms of investment, you'll grow in terms of adoption. So you're going to see a lot of adoption going forward. And so that's a big space to follow as well. Closer to what you're doing, digital wallets is going to be huge. So based on research done by ARK Invest, digital wallet represents a $4.6 trillion opportunity, 4.6 trillion US dollars. And digital wallets penetrating the full deck financial services. In many countries, you do not need a banking license now to offer service that's pretty much to what banks are offering you today. Right? So other than just payment space, you can do money market investments. You can use your wallets to buy insurance, do brokerages, do lending, and they are replacing banks and branches in many instances, right? Most importantly, they serve as important lead generation platforms for commercial activities beyond financial services products. In China, which I like to cite because people in China, they go out now without wallets, without physical wallets. What they need is extra power bank for their handphones, right? Because everything is in the handphone. Digital mobile payment exploded 15 times in the last 5 years in China. It went from 2 trillion in 2015 to 36 trillion today, right? Roughly 3 times the size of China's GDP. And China has a huge GDP, as you imagine. But if you look at the amount of transactions taking through, people are just relying on their handphone, their digital wallets for everything. So it's a huge area of growth, huge, exciting journey that most people are trying to ride now. If you look at the States, the average digital wallet size today range from 250 US dollars to 1900 US dollars. And that could scale up to 20,000 US dollars for each wallet user by the year 2025. People rely on that to do all their transactions, e-commerce, areas of insurance, areas of investment, trading, credit, custody, right? And important, sorry, let me move back. An important phenomenon is that the number of digital wallet users are surpassing the number of deposit holders in terms of pace of growth, right? So if you look at Square's Cash App, and if you look at PayPal's Venmo, they amassed 60 million active users in the course of 6 to 7 years. To amass that number, 60 million active users, took JP Morgan 30 years. So you can see the fast pace of growth that's happening in that space, right? And so it has become a global phenomenon. Many people are trying to angle into that space, other than Cash App that I mentioned, Venmo that I mentioned, WeChat Pay, Alipay, Grab Pay in the East, Revolut, Lydia in Europe, M-Pesa and Lulu Pay, I think, right, are really into that space. So it's a very exciting space to watch. And you can really imagine the future of the possibilities in that space. Bitcoin. I'm not a proponent of Bitcoin. So if you go and buy Bitcoin after this, it's not on me. You make your own call, you make your own decision, right? But this time around, if you read the media article, Bitcoin is at all-time high today. But this time around, instead of the hype that we saw way back in 2016, 17, 18, this time around, the market appears to be maturing, right? With increasing allocation from institutions. As I mentioned, for any asset class, without institutional allocation, it's going to be extremely volatile, right? Up and down, you see sharp increase sharp drop. But this time around, we see the likes of Tesla putting part of its balance sheet into Bitcoins and cryptos. You see PayPal allowing buying. I mentioned PayPal has a big digital wallet, allowing buying and selling of cryptos. You see Visa rolling out its own platform for crypto payments. You see the largest bank in Southeast Asia, DBS Bank, setting up its own crypto trading platform, right? That shows increasing acceptance and maturity into this space. Right? And the traditional exchanges, the likes of CME, the likes of ICE are rolling out crypto products as well for trading purposes. And if you look at what's happening in that space, roughly 60% of Bitcoins have not moved in the last year alone. Right? Supporting the view that many of these people that are vested in this space are holding on for the longer term. And they have much stronger conviction than the early investors in that space, right? Whether you like it or not, we are living in a subscription economy, right? And this space is only getting much bigger. So you start your day today, waking up to delivered breakfast from Zomato, Deliveroo, Uber Eats. You go to the gym, listen to a music platform that you subscribe to. You go for lunch, paying via a digital wallet. You consult your doctor via telehealth platform, make appointments. You catch up on courses online. You watch your favorite TV programs on Netflix, Disney Plus, etc. Do dating via Match and other platforms. And of course, e-commerce is a big part of that narrative. So this is a big mega trend. You're going to see greater monetization on the subscription platform. Many people are very used to it by now. Be it e-commerce, e-learning, e-health, and those are big mega trends that you're going to see going forward, right? So, and there are other mega trends that's less relevant, which I'm not going to touch on. So if you look at the EV space, the way it has taken off, automation, autonomous, ride-hailing, cell and gene therapy, drone delivery, all this. So all these are mega trends that you're going to see coming forward. They'll impact our lives. So if you start to reimagine the future, especially in financial services, what is going to happen and what will be powerful that is going to happen, right? If you imagine everything is going via your handphone, subscription-based economy, if you can create a super app where you do all your transactions via a digital wallet, your insurance, buying air tickets, booking trains, consulting doctors, placing money market funds, buying cryptos, doing e-commerce shopping, right? That will become a very powerful super app, right, of the future, right? So if you start to reimagine and how do you strategize, how do you tap some of those business opportunity, the future belongs to players that can use artificial intelligence, they have good data scientists, they can use data sets, right? Players that has plenty of consumer data, e-commerce site, venturing into financial services because they have big data sets of consumers. They know how consumers behave. They can route things like buy now, pay later, for instance, right? And use that to branch into other areas. You see some ride-hailing apps, the Grab of the world, pushing into financial services. Again, because they're big data sets, they're big AI, they can push into that area. So we are going to see a lot of those people with big data sets, the likes of Facebook, trying to introduce Libra, which is a huge payment system globally, because they have big data sets. And those become extremely powerful and important as you know people's preferences, right? And that becomes an important lead generation for businesses. If via AI, you know this person is looking for a pair of sneakers today, And as the person walk past a shop and get prompted to say that there's sneakers discount, the type of sneakers that you like, right? Imagine how powerful that is. So you're going to see a lot of all these new things coming into the marketplace. I'm going to touch a bit more on COVID and what's going to happen for global economies and how we work, consume, and live, right? So COVID is a health crisis that led to supply chain disruption, a demand shock, massive lockdown situation for a period of time, mass unemployment, financial challenges. In the immediate aftermath of COVID, what you saw was the plants were shut down, especially in places of China, and that created a huge disruption in terms of supply chain. And supply chain is pretty delicate. Just look at what happened to the Suez Canal last week, right? A blockage, people are saying commodities prices are going up, livestock prices are going up. Supply chain is pretty delicate, and people understood that in the first instance because of COVID. The quarantine measures, the lockdown, curtailed spending, and that imposed hardship on many businesses, right? And many players, many places saw huge drop in disposable income and e-commerce. So those were playing out for a period of time, and that forced the government to come in with unprecedented amount of liquidity and money to support the economy. If not for that, we would have faced a much worse crisis this time around. And it's only because of that this time around, I think we came out and recovered pretty quickly in many areas, right? So what are you going to see going forward? You're going to see, because of the amount of money that government has pumped into the marketplace and the amount of money that government will need to continue to spend in different areas of healthcare, because government got caught out to say that they don't have enough good healthcare systems, right? They don't have enough good pharmaceutical plant to manufacture products. They don't have enough labs and testing. So government are spending in that area. Government are spending in the area to secure your own supply chain, because they understand supply chain becomes so vulnerable when you're so reliant on China, and China, one country get impacted, the rest of us all get affected. Governments are encouraging businesses to bring back manufacturing closer to home to secure the supply chain, right? So a lot of people are talking about inflation now, especially in the States. One of the key reasons why you see inflation coming through is because in the past 3 decades, you have relied on cheap plants, cheap manufacturing in places like China, in places like Vietnam. As you bring those manufacturing closer to home to secure a supply chain, the cost differential will be there. And that's where you see inflation coming into play. The government, in order to finance all this new spending, you'll see increase in taxation, especially for the higher income group of people, to finance all this spending going forward. And you're going to see much more protectionism, right? Any crisis of this nature is going to lead to xenophobia, right? You see in the West, in different parts of Europe and US, anti-Asian sentiments, right, today. And this is likely to happen. It has a tendency to cause mistrust. It's a tendency to target minority groups, because they think that either this group causes it, this group are taking away our jobs. Political spats are still happening at a country level on COVID. So tensions will continue to exist, right? Governments become much more protectionist. It tries to develop its own local champions. It tries to secure not only supply chain, food stocks. Food security becomes extremely important. Biomedical supplies, pharmaceutical areas, defense, financial services is extremely important, right? So government is going to spend a lot more into each of these areas to bring about localization, to make use of things like 3D printing, automation, to bring a lot of these things closer back to home. And of course, digital adoption that you saw during the crisis. It is going to be a much more digital world. So a mega trend that you saw before the crisis actually accelerated that trend. Because in a lockdown situation, there's no way that you can go to a physical branch of a bank. you can only shop online. You can only buy your groceries. So before crisis, the percentage of shopping on a grocery level online is 3%. So it's pretty low. People prefer to go to supermarket, look at the products, look at how fresh is it before they purchase. And that went up sharply during the crisis, as you expect. And consumer trends, habits change. People realize it. Hey, this is easy. I still get very good products. I don't have to carry heavy bags home. This is a much easier way to shop. So consumer patterns have changed post-crisis, and the crisis caused and accelerated all those trends, right? Students are more used to e-learning today than before. In the past, business meetings, you have to fly across half the world. Going forward, people are more used to Zoom, Microsoft Teams call instead of spending long period of times on the plane, right? Entertainment has really, if you look at the number of subscribers on Netflix and Plus in the past 12 months, it just started, right? Again, all these are changing how we consume things. Work arrangement has changed. Number of tech firms say that their staff don't need to go back to the office until end of this year. Some of them are given very flexible working arrangement. So if you think about it, even for future cities, if this trend continue, the need for apartments in places like New York City, which is an extremely expensive place to live, right, will change. Because if you tell your staff today that I allow you to work from anywhere in the world, as long as you're happy, as long as you clock in the hours, as long as you deliver the goods, they will choose to go live by a beach, live by a nice golf course, right? Live in a place where, you know, they are going to take care of their family, have much bigger place at much cheaper prices, right? Instead of staying at a small apartment in New York City. So those things could have longer term impact of how city build themselves, and the demand for places to live, how you set up your family office, etc., etc. We see a lot of vulnerabilities in the short term. As I mentioned, without the unprecedented support by government, this would have been a much longer crisis. It would have been a much worse crisis than we saw. And some of the firms are impacted in the short term in the digital world. But I think something that became very clear via this crisis, if it's not so clear prior to the crisis, is we are moving very rapidly into a digital world, right? The digital-only format will become the norm for financial services going forward. It is during the lockdown situation, you can't open a new bank account, right? If you remember, things like KYC can only be done online, right? And in this part of town, many things are still, you still need face-to-face meeting, you still need physical. So all those things will have to change, and they have to change very quickly. In the States, when they try to roll out the payroll protection program for small, medium enterprises that need support, they discovered, and they used the traditional banks to roll out those support measures. They discovered the banks have no way to onboard new customers on a remote basis. They need face-to-face. As a result, the banks lend those money to existing customers. And most of those existing customers are big boys. They don't need the money, right? But the banks are just lending it to them. And that created a huge fiasco. The government pulled back the money from all these companies to say, look, these are not the people that we want you to lend to support the local community, because they have no way, no means of doing that. They have no way of doing proper credit analysis in a remote fashion. They have no way to do proper KYC onboarding on a remote basis. So all those things are forced to change. You see much greater competition. The banks realize during the crisis they are losing out in a very fast manner to all these new entrants in the marketplace. The bank realized in the past they have always relied on in-house development for their own IT needs, for their new projects, for new areas of venture. And that's not tenable because they're moving at too slow a speed compared to some of these new disruptors coming into the marketplace. So increasingly, they are working with these new disruptors, or they are relying on external help to help them scale up quite quickly. Some of the big winners that we saw, I mentioned digital wallets. There's a big area. Lending platforms that can adapt to the needs of new players, that can conduct new areas of credit analytics. Many areas where traditional banks are too conservative to lend or don't have proper credit analytics to lend to them, don't understand those marketplaces enough. You see all these new entrants gaining market share very quickly. Tokenization of services, tokenization of investment products, that's going to be a big area, right? That we're going to see, because it's much easier. You can tokenize anything, an office building. You can tokenize it, sell it in smaller blocks so that investors benefit from the rental yield from a particular building, for instance. Mortgage and life insurance digitization is a big area, because this area is really still underdeveloped and players have not placed too much emphasis on this area. It's still, in many cases, insurance products are sold, they are not bought, right? But given the type of technology advances, the new business model coming through in this space, we are going to see a lot of innovation in this particular space. So the big winners, or rather the winners that we are seeing, fintech enablers around AI. I mentioned those people with data sets, with big data sets, with good AI, with good data analytics, credit analytics, will win big in the new economy, right? Bots for call centers, account opening procedures, loan automation, remote KYC has increased sharply. So all these are new areas, and you have new entrants from other parts of the economy, from e-commerce, from ride-hailing, really muscling and seeing that they can actually use their data set to muscle into these areas of growth. Challenger banks, I mentioned your digital wallet is pretty much like what a bank can do in many instances, right? What you can't do possibly is just deposit taking, right? But then there are other options. You can, digital wallets, stakeholders can place money into things like money market funds, which is pretty much earning interest rate on deposits, right? So there are so many things that can happen in digital wallets that some of them will pose challenges to digital banks, because the new challenger banks, they don't have the same data sets that some of the traditional banks have. They don't have the same product offering. They are still burning a lot of cash today as they try to get up to profitability. So they may face challenges going forward, right? So you see plenty of opportunities, you see some challenges, you see business model evolving, right? So I'm coming to the end of my presentation. I hope this is useful for you in terms of rethinking financial services, rethinking the mega trends that's going to come forward to us, and harnessing and taking advantage of some of those opportunities that will come forward that will allow you to be even more successful in terms of your business and new business model. Thank you so much for your time.
You have told us the world is flat, so that Western Union sitting in USA can compete with me here. And you have also told that globalization is getting demolished. Each country will have its own environment, particularly supply chain, etc. And thank you very much. Thank you for my colleagues to have a patient listening. And thank you for arranging this meeting. Thank you so much.
Thanks. Thank you, sir. That was very inspiring.